Welcome to the Power Exit Podcast. This show is dedicated to business owners who want to scale up, plan smarter, and prepare for the ultimate exit. We'll talk with M&A experts and owners who've been through the process to provide actionable advice so that you can sell your business on your terms and without regret. I'm John Marsh. Join me as we prepare to take control of your exit. Welcome back to the Power Exit Podcast, where we help business owners take control of their exit and sell their business on their terms without regrets. If you've been following the show, you know we've already touched on the importance of a quality of earnings report, or QOE. But this topic is so crucial and often misunderstood that we're coming back to it today from another angle. Joining me is Caleb Lloyd, a partner at Smith & Howard, a family of companies helping businesses tackle just about every challenge they face. Whether it's tax and accounting, preparing for a merger or acquisition, managing cyber risk, finding and retaining top talent, or even personal wealth planning for business owners, Smith & Howard is known for providing smart solutions with an unusually responsive approach. Now, Caleb works at Smith & Howard with both buyers and sellers on financial due diligence and transaction advisory. Caleb brings a sharp, real-world perspective on what QOE is, how buyers use it, and how sellers can leverage it to protect their valuation, reduce deal friction, and stay in control of the process. Whether you're thinking about selling now or a few years down the road, this episode is packed with insight that can save you time, money, and stress. Let's get into it. Caleb, thank you so much for being here today. I'm thrilled to have you on the Power Exit Podcast.
Yeah, thanks for having me. I'm looking forward to it. I'm a huge podcast junkie, so this is, like a bucket list item.
Oh, there you go. Well, you can bookmark and save this one and tell all your friends about it, that you were on the Marsh Creek Power Exit Podcast. So, Caleb, tell us a little bit about what you do at Smith & Howard and the types of clients you advise during a transaction.
Sure. So the majority of my time is spent performing quality of earnings engagements and just kind of other M&A advisory. So helping out with networking capital calculations, networking capital disputes, reviewing purchase agreements, and just supporting the diligence process. When I'm not doing that, I also oversee our SOC audit practice and help out with our CFO controllership services group and just kind of other general consulting kind of work.
Yeah. Great. Well, I was thrilled to work with you on a recent transaction that Marsh Creek did. You represented our client. He had, I don't want to say concerns, but he was very diligent about networking capital. And unfortunately, he didn't engage a full QOE, but he did, and you did help on the networking capital target, the buyer's calculation, reviewing that with us. So it was a pleasure to work with you on that. So thanks for your help. We've covered it on the Power Exit Podcast before, but just from your perspective, or just to refresh the audience's memory, tell us what a quality of earnings report is and also what it is not.
Sure. So, the biggest thing is really just helping buyers and sort of investor understand just what the business actually is earning kind of month in, month out. What's that recurring revenue stream and the ultimate earnings of the business look like? And it's not just looking at tax returns. It's not looking at audited financials. Those are serving different objectives that we're going to talk about later. But just looking at the core of the business, getting rid of some of the non-essential elements to give everybody a clear picture. It's not just checking boxes. It's not following a specific set of rules. It's just understanding the business, the story that we're trying to tell, give everybody the confidence to believe in those numbers and understand the decision that they're going to make as a result.
Right. Who are you mostly engaged by right now at Smith & Howard? Like, who are you mostly representing? Is it buyers? Is it sellers? Combination of the two?
So it's a combination of the two. It kind of ebbs and flows. Sometimes it'll feel like it's more buy side, and other times it'll feel more sell side. So currently, I think we're in a sell side cycle of things, but for us, it's about a 50-50 mix. Maybe a little bit heavier on the sell side, but pretty comparable on both.
Yeah, and just anecdotally, tell us why you think that is. Why do you think you're seeing more activity on the sell side now? Do you think that it's because the sellers are recognizing the importance of a QOE, or I think that's important and interesting to talk about the cycle. So would love to hear it from your perspective.
So I do think there's an element of just a QOE, and especially the sell side QOE, getting just more, call it brand awareness in the market. People are much more aware of it. People are starting to see the value of it and just how that can be used in the context of the transaction. And I think that's becoming easier than when we work with folks like you. You're not the folks we have to convince of the value of it and the benefit of doing it. It's the business owner who's ultimately going to be the one that pays the fee. And I think that there's just enough stories floating around now that that awareness is getting easier. And then it feels like the cycles kind of go of, as buyers come in and out of the market, then naturally, bunch go through cycles and the acquisitions happen, and then it's time for the next wave. So I think that's part of why we just see that continuous cycle. And a lot of deals got put on hold just as the interest rates changed. You had a lot of uncertainty over the last several months. And so that kind of hit the brakes on everything. And then that volume's been coming back. And so it's been quite busy for the majority of 25 here.
Awesome. Well, yeah, and we're recording this in the summer of 2025. So, I don't want the audience who listens to this, a year from now to be confused. I think the content of this discussion is going to be relevant for many years to come. But just wanted to leave that with the audience too. So from a buyer side, right, we're sitting on the buyer's perspective. So let's just educate everybody. You sign an LOI. Well, you marketed the business, you've run a process, you've selected the buyer, and you've signed a letter of intent. At that point, a buyer is going to engage a firm like Smith & Howard to do a QOV. Tell us a little bit about what they're trying to accomplish. You touched on it a little bit at the beginning, right? To understand what they're buying, make sure the financials are correct, what the cash flow is of the business. But what specific risks outside of those is a buyer looking to uncover?
So currently, I think the core risk is, are we buying what we think? So that's a really big statement. And especially in the lower middle market where the bulk of our work is.
And let's define that, if you would, Caleb. What's that mean for revenue or EBITDA for your general, and then generally, what's that mean?
Yeah, I would say, kind of a straight down the fairway client for us is in the 50 to 100 million top line revenue. So the EBITDA, 2 to 10 is kind of where most of our transactions are.
Yeah.
And I think one thing that's really important in that space, when you just say, well, what's that mean? Are we buying what we think we're buying? There, the accounting records, that's a very broad term. And the ways that people are keeping their books and accounting for transactions are myriad. And, I often talk about it in this space. These books are serving an operational goal first. And so often they're closer to cash than they are to accrual. If they've got accrual books, period, they're accrual-esque. And so you've got some like this hybrid blend. And so unpacking that and just helping someone else understand what that really means and what it looks like is kind of the first thing that I always think of what we're doing here in this space. And it's hard to do as a buyer to just come in, take a set of financials and say, great, this is what that business is doing, because there's a lot of nuance that's happening behind the scenes that until you just become aware of them, you don't know until you start digging in. More examples that we're going to talk about as we go through with some of the stories. But I think that's really the biggest thing in this space. And then, when you get down below that, some of the risk, or do you have changes in customer relationships? We lost one, have we gotten a really big one? Another one is just have we fundamentally shifted kind of our business strategy? I've got another great example for another question later that really gets to that. Hey, we changed our target customers, and that's really shifted what our business looks like. And you can't compare this year to last year anymore. So we can help correct for those things. So it's those types of risk. There's changes in margin. Another one that was really good during COVID, when all the commodity pricing went haywire, it just made comparing these financials almost impossible, because their revenue had blown up and nearly doubled, but they were making pretty much the same amount of money. And when you really unpacked it, they were selling plastics. And so the cost of resin had gone through the roof. And when you just convert it and you quit looking at it with dollars and just looked at volume sold, the numbers were essentially the same. So it's really the business was comparable one year to the next. You just had to get rid of the noise of that commodity pricing. When you did that and looked at their OpEx again, so okay, this business makes sense and it's been really consistent. Not all of a sudden they doubled their volume with the same number of people. That's the
Right. Got it. Okay. Well, that's helpful. We'll talk a little bit later about, the core areas of a quality of earnings report, kind of what you're going through. But I want to, we've talked a little bit about the process, right? When a Q of E, if you don't do a sell side where you're preparing well in advance, if a buyer is doing a quality of earnings, what does weak or unclear financials signal to them? What is their common reaction? I know it depends is an answer we like to give or have to give a lot because every deal is different. But tell us, what buyer's reaction is when the QV raises significant issues.
Well, certainly, I think the biggest risk is just lack of credibility. You've
Yeah,
told people one story, and then all of a sudden they start getting a conflicting set of information, and now you're having to scramble to explain that. And if the story keeps shifting, people are just kind of in every facet of your business, they're going to start asking, well, what's the truth? And how well do you actually know your business? And especially, if you're the person exiting, then it needs to be the other people within the business really in the best position to answer it. And so even as a buyer, when we're representing the buy side, that's something we're thinking about. If all of the answers are coming from this one person that's going to be gone after the
yeah,
transaction closes, that that's a risk that we're looking for. And then even if you're going to be sticking around, again, it comes back to depending on the buyer, there's a level of sophistication that's likely to exist in the buyer. And if you're not able to meet that, and just understand the business in the same way that they're wanting to, I think that becomes detrimental longer term. Just what's your role in this business after the fact? So the credibility is a big one that we see at the moment.
no, that's helpful. That's great. Thank you. Um, Now, I didn't give you this question in advance. I'm part of the Power Exit podcast is throwing our guests for a loop. But is there a difference in the scope of work between a sell side quality of earnings where, our client is going to market with a quality of earnings report versus the report that a buyer may engage Smith and Howard to do?
So broadly, I would say no. Uh, and it certainly can shift. I think, the buyers tend to be willing to spend a little bit more money
Yeah.
because now they're making sure that the purchase price isn't going to be at risk. I think for sellers, that can be a little bit hard to really connect the dots all the way to the end game of what's this going to look like. So often they're coming to the table saying, look, I want to get kind of as much value as I can for a smaller price, which I understand that. We all want that. Whereas the buyers are saying, well, if I'm going to spend 30 or 40 or $50 million, I want to make sure that we're not encountering something that's unexpected. So I think they kick the tires a bit harder.
Yeah. Yeah. Well, and you've touched on it a couple times, so I'm going to ask, what does a quality of earning, and again, it depends, but what's a quality of earnings generally cost? What are your fees for a report?
So I think within the market as a whole, what seems to be a pretty fair price point is somewhere in the range of 40 to maybe 70. And of course, you can go up higher than that, uh, especially if you start getting into full scope or there's really specific issues that need to get handled. And kind of that 40 range is what everybody seems to be calling a QEV light, to really just focusing on getting the financials and an adjusted EBITDA number. And you skip some supplemental analysis, but it's adjusted EBITDA and net working capital seems to be the way most everybody's defining that QEV light.
Yep.
Um, and that, especially on the sell side, seems to be kind of the most popular offering. There,
Yep.
then the buyers tend to be more likely to go for the full scope. But even there, if it's a small add-on deal, then they'll say, "Yeah, let's just do something light. I just want to make sure this is a real business that's got real activity. Are there any major misses?" And then if we find something, we can always opt to dig in more. But let's do that because the economics of this deal just don't support a full scope.
Got it. Well, thanks for answering that. And I know it does depend, right? A manufacturing client may be a lot different, or is a lot different than a service provider. And if you're having to test inventory or look at inventory, and margins may fluctuate in that raw material example, I'm sure that adds more time, which probably adds more costs, right?
Yeah, and the quality of the books is going to be another one that I know it's another question later to touch on, but that greatly impacts that scope. I mean, if you're going to be down at 40, that's somebody that's got really good quality books that are already pretty close to accrual basis. They're not running a lot of personal expenses through there, because the harder we have to dig to find those, that's time. But
Yeah.
yeah, the other thing that's always helpful, more on the sell side, but the value of those add backs. If you're going to be able to adjust EBITDA and then get a multiple of 4 or 5 or even more, depending on the sector, you can pay for that really quickly.
Yeah, for sure. Well, now we're going to get into the meat here, which is, the stories. But can you share an example, of course, anonymously, of when an issue or a QV surfaced an issue that changed the deal dynamics?
Yeah. So I thought about this one, and we have one where we were representing the buyer, and just early in, they'd gotten the sim, and margins had improved from something like the mid 20s up to the low 30s, which on paper everybody was excited. That's great news. We'd love to see that. Um, but the buyer was just very skeptical of that number, and rightfully so. As we started digging in, and you ask, well, are you doing the same thing that you did last year? And the answer was, yeah. Okay, well, are you selling to the same customers that you sold to last year? Well, yeah. Okay, well, then how did you increase margin by a third if you just kind of doing the same things? Uh, and so as we started digging in, what jumped out really quickly, we like one of the sayings that we have in our group is, a year hides a lot of sins. And so looking at financials on an annual basis, noise just gets obscured. And so, but as soon as you looked at them on a monthly basis, you could see the issue. And in 1 month, their cost of sales just went to zero. You start digging into that, and there was an adjustment from one of their other service providers that made sense in the context of what that provider was doing. But it didn't make sense in the context of what we were doing. And we said, well, rather than that adjustment running through this TTM period, which is trailing 12 months for anybody that doesn't know the acronym, this is really something that has built up over the years, and should run back into a prior period adjustment, which pushed it out of the TTM period. And so the net effect of that was dropping EBITDA by roughly 40%. And all of a sudden, the economics of the deal, when you're talking about 40% and applying a 4 or 5 multiple, I think in this case it was even more, but it dropped the deal value 40%, and that was just too big a gap to recover. I mean, at that point, sellers have a number in their head. That's too big a spread, and so the whole deal fell apart. And it also really impacted the credibility. As the business owner, if you didn't have that and weren't able to articulate what that was, then what other things exist within your business that you're unaware of or going to be unable to articulate?
Right. And that's a powerful example. I mean, um, my job is to take a business to market and avoid a retrade, right? We want to honor the terms of the LOI, and the buyer, generally the right buyer, wants to do that as well. But sometimes I've seen it happen as well, where an accounting adjustment or treatment um, increased EBITDA on a deal that had 3 million of EBITDA, increased it by 1 million. And that's a third of the EBITDA that was incorrectly accounted for. Challenge with that deal was they had a CPA. They had an opinion letter from a CPA. And it unfortunately just didn't hold water. So that speaks to the quality of a team as well. That CPA, I'm sure, was very good at what they do, but they don't do deals. And going to market with accurate numbers, a sell-side QV, going to market with a sell-side QV and accurate numbers increases the probability of avoiding a retrade. It increases the probability of you closing at the terms of an LOI. So thanks for adding some context there in a real world example. Um, I guess, yeah,
One other thing on that one, we were representing the buyer. So once we found that, the investigation of it kind of stopped.
right,
We did the the seller asked us to kind of help them just understand it better. And one thing in that situation, had a sell side QOB been done, one you already touched on, that would have been factored into the value
right,
that went into the sim and everything. So the marketing would have been totally different. But we also, for the provider that made that adjustment, it was the right move. They just needed to get to cash basis books. That accomplished that goal. That was the answer. They dumped it all into one period. You know, I think the real answer would have been some of that should have been in this period, but a lot of it would have been able to move. And so rather than it being a 40% drop in EBITDA, it may have been a 20 or 25%. So it still would have been bad news, but we could have dug in on the sell side and really fixed that beforehand. And we can also message that differently. So when you're looking at the Q of E and somebody sees an EBITDA adjustment for an accounting error, you can talk about how that actually came to be and why that exists, and at least kind of control the narrative around it and just not make it look like we don't know what we're doing. You can say, "Oh, we knew what we're doing. This is just an issue that kind of accumulated and we had to just correct it." Uh, and so I think that's something that people don't really think about in the context of a sell side that I know we'll talk about later is just having somebody else on the team that can articulate those messages and be part of the story in a different way than the rest of the team.
right, right. So I'm going to ask you a question about the common things you see, right? How often do the issues that arise relate to whether it's revenue recognition, normalization adjustments? I do want to talk separately about ad backs, but you can touch on that in your answer, of course. Is there a common theme you're seeing among the lower middle market businesses that you're looking into?
Yeah, revenue recognition is one that is part of almost every transaction, kind of regardless of what industry it's in. Certainly, you've got some industries where things can be really complicated. So, construction is a really big one. Most construction companies should be on percent complete accounting, and most of them in the lower middle market are not. So, their revenue lines up with their billings. That's not what GAAP would say. And so that can be a big shift, especially depending on how you operate your business. If you are really aggressive and able to pre-bill customers, then you've got a lot of revenue sitting in this period that really belongs to the next period. So we come in and do, whether it's buy side or sell side, we book those adjustments. You're often damaging your current period, but to the benefit of your next period, which kind of ends up being a net win. Even though we're taking EBITDA away from you, it's adding to the backlog that the buyer's going to get. So that can be really favorable.
Right.
If you're in a position where you're often funding the jobs yourself, then those adjustments can work the opposite direction. And, we may be able to accelerate some revenue that you haven't yet gotten by booking. Uh, it's not called this anymore, but it used to be called cost in excess of billings. Now it's a contract asset. The gap names changed, but it's the same idea of just, you're underbilled and that's accrued revenue and we can book that. So revenue recognition is big, even outside of a contractor. If you have long-term contracts, this can be a big one. And the last few years, I forget the exact year, but it was 3 or 4 years ago, there was a big change in the gap guidance for revenue recognition. And it's 5 easy steps that the white paper on it is 600 pages long. So it gives you an idea of how easy those 5 steps are. But the devil's in the details on anything RevRec related. We had a pest control company that we were working with that they had long-term annual service contracts that entitled you to 4 visits a year. So the question was, well, should you be booking that revenue every month or each time a visit gets done? And it felt like the way that the contracts were worded that it was every time a visit gets done. So you would have said, well, that means you only have, revenue every quarter on these things instead of monthly or anything like that. But then there's this like one line in the 606 talks about a stand ready contract, and the kind of the golden nugget in their contract that we found was uh, the callback visits. So yeah, they're going to come back every quarter, but if you find bugs in between and call them and say, "Hey, I need another treatment," they'll come and treat at no cost. And so that gets called a stand ready, which means then you can recognize revenue every month just over the term of your contract. And so there's just a lot of nuance. It's hard to unpack, and if you don't really understand the rules, it's hard to explain to the next person. We have another client that does something that feels a bit like construction because they're digging in the dirt and they got muddy boots, and everybody wants to put them on percent complete accounting, but that's not how their business really works. And so they should be doing what's called a unit of measure. So every time they do X amount of work, they get that revenue, and for them, that's a really big difference. They really can't do percent complete. And every time the buyers came in, so well, yeah, you're digging in the dirt and you have muddy trucks, so you got to be percent complete. And they were having a hard time articulating why that was not the case to the buyers. And they finally just called and said, "Can you explain this?" And I know what the accountants want to hear, what the buzzwords are. And as we talked through it, they said, "Okay, yeah, that actually makes a lot of sense. It's not percent complete. It's unit of measure." And so I think that's another part of the whole process that's just underappreciated, is the ability for one set of accountants to talk to the next.
Yeah, 100%.
That kind of out of the hands.
All right. I'm going to put you on the spot here, Caleb. A lot of our clients are probably listening to this thinking, what is revenue recognition? So maybe explain that, but also what are the 5 key items in the ASC that a business owner should be aware of when you're looking at, was revenue properly recognized?
Yeah. So it's a great question because we actually I just had a client last week email and trying to wrap their arms around how to do revenue recognition within their business. And in my email response, part of what I said to them was, look, we need to first define what is revenue, because most business owners, that definition is, well, I either got cash or I billed something. And that's great. That's just not the GAAP definition of revenue. And so I think first and foremost is really separating those two ideas. Billings are billings, cash is cash, and that's really important. But revenue is totally different. And so within the ASC 606, which ASC is just accounting standards codification, so it's just the GAAP accounting rule book. They break it into 5 easy steps. It always sounds like a late night infomercial to me.
And they're so easy, yes.
So easy. My 4th grader could do it. And so the first step is identifying the contract with a customer. So do you even have a contract? Which again, on its face, you would say, well, yeah, sure, we've definitely got a contract, but not always. And especially if there's I could have an engagement letter that just says, John, I'll do stuff when you need me to. Great. That's not a contract because we haven't laid out any kind of collection enforceability or what are the actual terms, what's the consideration that we're going to exchange. And so it would be easy to say, well, yeah, I've got this contract with John, but that's not a real contract in GAAP. And so it doesn't mean anything. The next thing is identifying the performance obligations in the contract. So that's a new word in ASC 606, but it's kind of a simple idea. What are the things that I've said I'm going to do? And for contractors, that can be really a tricky thing to answer. And this is true for anybody. Maybe a manufacturer is an easier example. I can have one performance obligation, which is I'm going to build this thing and you're going to buy it. And that would be great. But often that thing comes with one other thing, which is a warranty. And so that warranty represents a performance obligation, or often can, depending on how the contract is worded and what that warranty is. And so now I have 2 things that I have to do for you. And that becomes really important into steps 3 and 4. Which step 3 is determining the transaction price, which again is often kind of easily said. Just, hey, what's the contract say it's going to be? But that can also be really challenging in examples where you don't necessarily know what the contract's going to be. So one of my clients that buries fiber optic cables, that's a good example for them. They don't really know what the value of that contract's going to be. The contract holder comes and says, I need you to get this entire node connected and operational. Do whatever it's going to take. Well, we don't know what it's going to take. Sometimes we're going to have to hang the fiber on a pole. Sometimes we got to bury it. Sometimes we got to go through rock. So exactly what it's going to take changes. And so that determining the transaction price is not always easy.
Right.
The 4th step is allocating the transaction price to the performance obligations. So if we go back to that example of a manufacturer that's going to sell you something and then provide a warranty, often you have to think about, well, what's that warranty worth? And so I may have to say, well, if I'm going to sell this product to you for $1,000, maybe $900 is the value of the product and $100 is the warranty. And I have to separate those two, and I can recognize $900 when you take delivery, and the other $100 is going to have to be some mechanism that runs through the life of the warranty. So those things can be really nuanced. And again, in a contractor, it's not often the case because there's some ways you can change the narrative, but you could think of it as, well, pouring the foundation could represent one performance obligation, and then doing the framing could represent another performance obligation. And conceptually that makes sense, but again, the devil's in the details of, you would say, I forget the exact terms in the guidance, but it's essentially saying, well, the value of any one of those individual things is essentially zero, because what I hired you to do is build a house. So the fact that I can break up each one of those as its own performance obligation just doesn't make any sense in the context of the transaction, which I think is the actual gap wording. So yeah, even though I can break it up, doesn't mean I should, because at the end of the day, you hired me to build your house. And then the last step, once you've worked through those 4, then you finally get permission to recognize revenue as those performance obligations are satisfied. And again, that can often be, is it a point in time to where you don't get to do anything up until the very end, or you get to do something overtime, which is often the case with a contractor. As that job progresses, you get to recognize revenue. But it's really complicated. And especially then you start layering in things like if you're getting customer deposits, those deposits, that's real cash to you that you got to use to then go and acquire inventory or whatever it's going to be. But often those don't get called revenue until you actually start earning them. And so you end up with things like a deferred revenue on your balance sheet, which represents a liability. Even though you got cash in the door, I think as a business owner, you don't think of that as a liability.
Yeah.
You got cash, that's great, but it's representing a future obligation to fulfill a commitment. And so it ends up being a liability. So it's a really complicated idea, even though it does sound so simple. And I think, again, is for a lot of business owners, that's just not how they think about the world. And so it could be a gotcha when you start saying, well, you thought you were going to get $1 million out of that, but actually I'm about to park that whole thing on your balance sheet instead of revenue. And we're doing a project now where they're saying, where's all of my margin in my current period? And the answer is, well, you had a bunch of customers ask you to pre-bill them last year. So you had great margin last year, terrible margin this year because you're recognizing revenue when you build. But had we, if we were doing things on a gap basis, those two things would be evened out because we would have parked all of that revenue on the balance sheet so that it was available for use this year. So you get a very different picture of your business. And it makes it hard to operate your business sometimes if you're not following gap.
Yeah, so we've done a great job of scaring the pants off some of these business owners, right? So I guess because that's all important stuff. That's what the buyer's going to look at, right? And that's where I think a lot of clients and sellers underestimate the importance of going to market, having these issues identified. So let's kind of, switch gears and talk more about the seller strategy and how they can use a QV to prepare. So we've touched on a lot of these things. It's probably going to sound redundant, but how can sellers use a Q of E proactively, not just to check the box or pass the test, but to tell a clearer story about their business?
Well, so we're going to leverage our scare tactic from the revenue recognition. And you can, it's those types of things. You can have problems, and not all problems have to be solved. But we like to, every problem, if it can just be understood, that's really what makes a problem, is it's a mystery and we don't understand what it really means. I don't necessarily have to solve a problem if we can at least understand what the actual issue is and what's the result. And so, um, we had a client a while back that was in home services, and they had the most unique revenue recognition methodology that I've ever seen. And I've seen a lot of them at this point. And it was a really kind of complicated way that they were going about it. And I don't know what their original business rationale was, but it resulted in their revenue wasn't linked to a cash receipt and it wasn't linked to a billing. It was linked to when they were executing contracts. And so,
Well,
what happened is when you looked at their books, their margin was all over the place because they may execute a contract and then do the work a month later. And so their costs would hit in 1 month, the revenue would hit in the previous month, and then the cash outflow would actually hit, a month after that. And so just the business cycle looked really unusual when you looked at their books. And because of how quickly they had started and built the business, they had changed systems multiple times in the middle of all of that. So the availability of data was really limited. They just had really poor access to good quality data because of all these system changes. And so we were representing them on the sell side, and you correct for that as best you can, but ultimately, if there's not data, you just don't really have a lot of options. Especially on sell side where you're being told like, look, I don't want to pay more than X. So you've got these two constraints of you've got limited availability and limited budget. And ultimately what we came down to was I don't know that this is a problem that's got to be solved because
Well,
we understood the mechanism and we were able to understand what the impact of that was. And ultimately, we kind of landed on just as a way to get some additional comfort for a buyer. Quit looking at the business month to month. The sales cycle is so quick with when they execute a contract, when they do the work, and when they collect. If you just start looking at this business over a slightly longer period of time, all of this noise evens out. And so what we ended up doing was just presenting their P&L on a rolling 3-month basis. And when you did that, all of a sudden where they would have 17% margin and 56% margin and -3, it all smoothed out and it was ticking along at like a 30% margin. And to me, that was a good example of just those times where you can have a different voice in the room, and overcome some of those hurdles that really exist in so many small businesses. And it's just really difficult. A lot of firms don't really understand what it takes to run a small business and just understanding what your life looks like. And so in that example, I think, our client was just like, well, this is great. We've got somebody that understands we can't go back in time and recreate all of these records. And we can't just invent answers that don't exist. We've got to look for another way to answer the same question. And, doing that was one. And, ultimately, was it the ideal answer for the buyer? No. But I think it was at least a quick way to get their attention and say, look, these numbers aren't just made up. There is rationale and the fact that this works when you just look at the business cycle, at least pay attention a little bit longer, and understand the issue.
Got it.
And that same client was another good example of, you can really leverage a QB to tell the story of your business in a much more effective way. And I think, and again, in these smaller companies, they've not necessarily looked at the business through the lens of real data. They understand their business just because they've been there since day one and they know what it takes to run it. But how do you explain that to the next person? And data becomes the easiest way to do it. And that same client had really shifted the strategy of their business one year to the next and changed where they were getting their customers. So they were getting their customers from external referrals previously, and then started generating their own referrals at some point in time. And they ultimately were showing less revenue, but more profit as a result. And I think naturally anybody is skeptical of that trend of you did less work, but made more money. Those are conflicting data points. And the seller was having a really difficult time getting people to listen to that message long enough. Again, it comes back to, well, we've got this great story, but we don't have any way to point to it. And every time you say, well, prove it, well, we can't because we don't have records at that point because we've changed systems. And so in that case, we kept asking around and finally found it kind of just turned into this. I think I touched on it earlier. People just don't understand how business works. And we said, okay, if you're doing this level of business, 'cause they were doing tens of millions of dollars. And we said, you're not doing that much business on a legal pad in your center console. Like somewhere you've got records and you've got a scheduler, like you've got a process for this. Somebody's got to go out, estimate the job, schedule it, order the materials, have those things show up, do the work. It's got to exist. And so we ultimately found out that they had a really robust CRM system where they were doing all of that, which is a customer relationship management system. So we said, okay, well, great. Well, you probably got a lot of great data. And you start talking to the operations manager and he's like, oh yeah, we know everything about that job. We know where it was, the size, how much material we thought we were going to need, how much we used, all the different work streams that were going to go into that project. We said, well, great, we can leverage that. And of course, then their answer was, well, we changed CRMs 3 times in that same period. But they were savvy enough to say, well, we don't want to lose that data. So they'd actually kept that data every time they migrated. So we had this repository of data going back a few years that listed every job, how big it was, and what materials were. We were able to reconcile that close enough to the accounting records to say, look, these two things are kind of the same data sets. And ultimately, we were able to use that and kind of convert their P&L to a common element. So here you were able to say, look, your revenue per unit of X looks like this over the historical period. And you could clearly see it was going up. And you could see that the cost stayed pretty much static because that wasn't the metric that moved. And then we were able to also leverage that for where these customers came from. And so you could see the external referrals came down and the internal referrals went up. So too did their revenue and their profit. And all of a sudden, this story that they'd struggled to articulate and explain to somebody else, when you just looked at the data and you could just show those charts, this convoluted story became an immediate picture that you could say, yep, that makes sense. And really kind of shifted it. So I think that's another element of where the Q of E could be leveraged. It's just having a different set of eyes, looking at your business in a new way and asking the questions. And we've had a lot of clients say, wow, this was great. I learned more about my business going through this exercise than I ever expected. I thought I knew my business, but these are different questions and different challenges. That's helping.
No, it's extremely helpful and very thorough. Thank you. You're a great podcast guest because you have great examples and can tell a story. So, sometimes our clients come to us and they say, hey, we have reviewed financial statements, whether it's for bonding or insurance requirements, banking requirements, whatever that is. Why do we need a QV if we have reviewed financial? Very few of our clients have audited financial statements, but what's the response there? Why do they still need to go through a QV process if they have reviewed financial statements with an accounting firm signature attached to them?
So I'm going to preface this with, one, I'm a recovering auditor. So I did financial statement audits for the first 8 or 9 years of my career. And then a big part of our business is also doing audits. So I'm not going to disparage audits. But they're really serving 2 different objectives. And so one analogy I like to use is it's like playing Monopoly. If you've got that one uncle that is just a stickler for the rules and you don't deviate from those rules, that's the game that's going to blow up and
I'm that uncle, by the way. Anyway.
And ruin the family relationships. And there's a time and a place for that way of play. But if you want the nice, friendly game of Monopoly where you've got free parking and I don't know, you get $400 for going around Go instead of 200, you just have these house rules.
Yeah.
And I kind of view an audit and a QAV as those two things. Like when you're doing an audit, you are playing by the rules of GAAP, which are set by FASB, which is Financial Accounting Standards Board. There's rules, and we all have to follow those same sets of rules.
Yep.
And then we're also working with materiality, which the definition of materiality is essentially how wrong can these financials be before an outside user is going to change their opinion on whether or not to invest or lend money or whatever the case may be. So we're just working to get to materially correct financials.
Yeah.
Well, in a QAV, we're not working with GAAP because some of what we've already talked about is in some ways, while GAAP has a lot of merit for how to run a business, and there's a lot of reasons you want to be running GAAP basis books, there are also times where that's not telling you the operations of this business. And especially in a lower middle market business, the owner has a lot of expenses that may or may not be run through the business that are personal in nature. And even if they're not necessarily running personal expenses through the books, they're often getting comp that's above market or below market because who cares? They own the business. They can pay themselves what they want within reason, and they can get paid through distributions and things like that. And so the QAV is really serving a totally different objective, which is let's get to a point where this is representative of what's it going to take to run this business hereafter. And you can have add backs for personnel that are going to be leaving. So an owner is getting paid several $100,000 a year, and it's only going to take a couple $100,000 a year to run that business. That could be an add back. But in turn, you can also have, look, it's going to take 2 people to take this owner out. That's going to be comp that we don't currently have, and that can be a negative EBITDA adjustment. But the other way that these things really diverge is an audit is covering a year of time. And the further you get from that point in time, the less helpful those numbers become. So, here we are right now. A lot of businesses have already closed out June. Well, your 12/31/24 audit is already 6 months stale. That's another big difference. Like I can do a QAV through June if that's your most recently published month. And so it's a more current view. And the other piece is a lot of audit adjustments. They're just getting booked at year end. So we had a client that we did last year that was a pretty large client. They were north of $100 million, and they had an audit by a big national firm, and that audit was great. We talked to the auditors; they did a good job, and they did things exactly the way that I would have done them. Made total sense. But he just booked all of their adjustments in December. So when you have adjustments that may have been several $1 million, that just makes December look really goofy. And so a big part of our audit, the QAV effort, was actually undoing those audit adjustments and correcting for the period and trying to push them all the way back into the months where they really originated, which is just not a way that auditors are having to look at the world.
So what about reviewed? What about, and maybe let's, put your auditor hat back on, but what's the difference in an audit and a review for the audience? And maybe answer the question as it relates to a review, because I think that it's probably more likely that they need a QAV if they only have reviewed financial statements.
So I'm going to answer that by introducing 2 technical definitions, and then I'll explain them. Hopefully I get them right. Any other CPAs that are listening are going to fact check me on this. But with an audit, you are offering limited assurance. And that gets back to the idea of materiality. And I'm not saying these things are absolutely correct. I'm saying they are materially correct. And I'm going to do that by actually testing things. I'm going to look at invoices and look at bills that you've sent to customers. I'm going to do confirmations with a bank, which is sending them a letter saying, how much money does John have in the bank? How much money does John owe you? And things like that. So I'm doing substantive testing procedures. And in a review, I think actually I had it backwards. I think an audit is reasonable assurance, and a review is limited assurance.
So, Caleb, thanks for the explanation on audited financial statements. That's good to know. But a lot of our clients have reviewed financial statements. Maybe touch on the difference. Put your auditor hat back on from 8 years ago, and what's the difference in an audit and a review, and maybe talk about the need for a QV if there are reviewed financial statements in hand.
Sure. So first, I'll introduce just two technical terms, which an audit is providing a reasonable level of assurance, and a review provides a limited level of assurance. Those are the ways that the AICPA and the CPA profession kind of defines those two things.
Okay.
And what that means is a reasonable level of assurance. We're just getting to materially correct financial statements. So I won't say that they're absolutely correct. They're materially correct. And the way that I, as an auditor, answer that question is by doing substantive testing. So that's looking at invoices, confirming amounts with clients. Hey, customer X is your book said they owe you $100,000. I'm going to send them a letter. Do they owe you that? I'm going to do the same thing with banks in terms of how much cash does John have in the bank? How much does John owe you? So I'm doing a lot of test work in proving out with reasonable assurance that these numbers are materially correct. When we then look at a review, you're doing virtually no substantive test work. So that limited assurance is I'm going to get John's numbers and I'm going to do analytical procedures to say, how believable are these numbers
Right.
based off of what I know about the business and the industry he operates in and historically. So if I start seeing, hey, John's margin went from 25% to 40%, I may start asking questions. But it's a lot of inquiry and very little substantive test work. And so the expectation that I, as somebody doing a review, would have a level of knowledge about the transactions and the flow of those transactions and what actually happened over the course of the year, it's pretty limited because short of just looking at the numbers and saying, that looks weird, I don't have a lot of way to detect that there are issues. When I'm doing test work under an audit, there's a lot of mechanisms for these things to fall out. But in a review, it's really, what do I see just as I go through the numbers and do the analysis.
So, and that's important because in a QOV, you are doing some testing, right? You're doing a proof of cash, probably at a minimum, but you're actually looking into things. Would you say that a QOV is more similar to an audit or more similar to a review for the audience?
So I would say it is more similar to an audit. Often we're gaining access to your system directly with a lot of our clients, which even when I was on the audit side, that was virtually never. Just starts to blur the lines of independence. But in a QOV, yeah, I'll grab your books. And we're going to be going through the GL in detail and looking at transactions line by line within the accounts. And then, to a degree, we may get invoices to support some of the add backs. We may get contracts and things like that, just depending on the needs of the engagement itself. And then, cash proof is often done, especially if there's not an audit or a review. That's a great way to just produce or provide a lot of credibility on the numbers themselves and just say, there's real transactions backing these numbers because we can link them to a third-party source, which is the bank, which may be helpful for people that don't know what a cash proof is. That's reconciling the activity in the bank accounts, the deposits and the withdrawals to the activity within your accounting records.
Got it. Yeah. So let's come back to something we touched on earlier, and that's add backs. Oftentimes, a client has many personal items running through the business. We try to do a good job of throwing some out that don't make any sense because owners think that an add back is a multiple of revenue, a multiple of EBITDA, and they want to get very aggressive. So just talk to me a little bit about add backs, what you see as valid that doesn't give you too much heartburn, but maybe a couple line items that you see on a recast that says, oh, we need to dig into that.
Yeah. So Certainly add backs that are just kind of correcting or cash to accrual conversion. Not to say that we're not going to look at those, but those are usually what I would just consider lower risk. They're pretty cut and dry. There's not a lot of judgment involved. So a bonus accrual is a great example, and it could be a plus or a minus depending on which direction. But a lot of businesses aren't trying to capture bonus expense throughout the year. They just capture it when it's paid. So you just end up with a huge expense at the end of the year. And that'll get smoothed out. And whether we're doing that on the sell side or on the receiving end of it, if we're doing buy side, that's easy enough to gut check and say, yeah, that makes sense. Um, Personal expenses can start to get a little bit trickier, especially depending on the degree to which those expenses exist. So, if we're looking at a business that's a couple of $1 million in EBITDA and, there's $75,000 in owner expenses, that isn't necessarily raising a massive red flag to me. That feels like a reasonable level. We're certainly going to look at it and try and understand what's in there, but that's a pretty easy bar to get over. But we've got plenty of examples of this, of a business that's $2 or $3 million in EBITDA, and then there's $1 million add back for owner expenses.
Yeah.
That's going to get a lot of looks. And you never know what you're going to find. We've seen it all at this point. And the important thing is getting in front of it. If we're on the sell side, I wouldn't say that $1 million is going to raise a lot of eyebrows, but you're going to need to have good support for it, and just be able to truly articulate what it is and justify that as truly owner expenses that are going to go away after the fact. And if you can't, that's when things are going to start crumbling. And our rule of thumb with add backs, and you kind of already touched on it, is the more add backs, the more scrutiny it's going to get. If you're coming in there and your EBITDA went from $200,000 to $3 million and it's all through add backs, that's going to raise a lot of questions.
Yeah.
But if your EBITDA was $3 million and you have 5 add backs that get you to 3.2, automatically people are going to be coming to the table and saying, that's reasonable. That feels good. That's not a crazy number. So I think all of those things are important. Another thing that's really important, and this is more of a plug on the sell side, but it's often the add back that's not there that would have been the most valuable. And another saying that we have in our group is, information is valuable. It's just a question of who's going to get that value. And if I am representing a buyer and we find an add back that's favorable, which we had an example of that a couple of years ago where we were doing a buy side project and there was some inventory costs that could have been capitalized within inventory. So it would have been parked on the balance sheet. Instead, they were just expensing it as it was paid. And it was a $200,000 adjustment that never made its way back to the seller. But, if you're getting a 6 multiple, that was $1.2 million that was left on the table. And there's no real obligation. I mean, most buyers aren't going to share the Q of E with you. You might get select excerpts of it, but you as the seller, they paid for it. It's their work product.
Yeah, 100%. We always ask for it, but very, very rarely do we get it. We normally get an excerpt from net working capital.
Yeah, I was going to say the network capital is the most likely to be shared, but the Q of E EBITDA adjustments are very unlikely to be shared.
Yeah. So Caleb, if a business owner is 12 to 18 months away from going to market, when should they start thinking about a Q of E, and what's the first step?
So, this is a little bit self-serving, but I also think it is really good advice. There's never a time that's too early to at least start thinking about it. And, as with any good accounting answer, yeah, it's going to depend. Because if you came to me and, your books were in really good order, you didn't have rev rec problems, or you didn't have a lot of personal expenses running through the business, we may say, hey, wait until you're closer to market, and we can do one that's fresh, and then your advisor can use that to build their sim. But if you've got messy books or a complicated accounting situation, complicated rev rec, then doing it sooner could be really advantageous. You've got some time to get the benefit of some of these things working through the system. If we said, well, hey, let's change how you're doing something. But often my advice is don't change it. Another saying that we have in our group is you can be wrong, just be consistently wrong. And we tell people, don't change anything. Just keep doing what you're doing. If it's worked to get you here to a point that you're ready to exit and you've got a successful exit on the horizon, just keep doing what you're doing and let the accountants handle the change. Because it's often harder to do a roll forward, which we're going to talk about if you change something. You'll keep dragging along. It's going to make my life a lot easier. But another reason I'd say that there's not a reason to not go ahead and start thinking about QV. It's not that difficult and it's not that expensive in the scheme of things to keep them fresh. So we often on sell side projects are doing a roll forward. So we do the initial effort on the QV, we publish those results and the advisor takes them and they're using them. And then we can add 2 or 3 months onto that QV and just keep rolling those adjustments forward and keep that deliverable fresh. And it's really a pretty economical way to do it. And we've done that in some cases. I think our current record is something like 2 years that we rolled the QV forward. We were often doing it kind of 4 or 6 months at a time. But it's because, the investment banker they were working with saw an opportunity. They'd made some changes to the business and they said, I think if we wait and let those changes really work through and we can start showing how they're paying dividends, we're going to have a much better story to take to market. And that's what they did. They were patient and I think they ended up more than doubling the value of the business by just waiting.
And knowledge is power. We talk about the power exit and being prepared. That's why we're here doing this podcast, because we're passionate about these business owners exiting on their terms. So that's a great example of the power of a QV. So Caleb, I want to thank you for being here on the podcast with me today. Where can listeners learn more about your work at Smith & Howard or get in touch if they're thinking about selling or just have a question about the QV process or really anything in general as it relates to their transaction?
Yeah, sure. So smith-howard.com is our website, and that's for all of the companies within the Smith & Howard umbrella. And right in the top right corner will be a contact. You can just fill out that form and our marketing team will make sure it routes to the right folks. Certainly QV questions will come to me, but we've got a wealth of knowledge within our firm for staffing and HR consulting and sales and use tax compliance and consulting and taxes and everything. So we love to just play the connecting game and make sure you're getting help wherever we can be of service.
Wonderful. Well, all of my experience with you has been that you are here to serve. I try to not have my eyes roll back in my head when you start talking about ASC 606 or whatever it was. But I do appreciate you being here, Caleb. I'm glad to have you in the network, and thanks for being here today.
Yeah, thank you for having me. It was a pleasure.
Absolutely. I hope you enjoyed today's conversation with Caleb at Smith & Howard. Smith & Howard is a family of companies helping businesses tackle just about every challenge they face, whether it's tax and accounting, preparing for a merger or acquisition, managing cyber risks, finding top talent, or even personal wealth planning for business owners. Smith & Howard is known for providing smart solutions with an unusually responsive approach.